The Bank of Canada, citing dilemmas and uncertainty, has held the overnight rate at 2.25%. And honestly, that's probably the only move it could probably make. Not because inflation was solved or the economy is healthy. And it's certainly not because most Canadians are feeling more prosperous. The bank held the overnight rate because two different data points were sending conflicting messages at the same time. On one side, you have inflation that is still persistent and a problem. Canada's headline inflation moved up to 2.8% in April, which is slightly above the 2% target growth rate. A major reason for this is energy prices and the conflict are not only around the world, but specifically in the Strait of Hormuz. Gasoline prices are up sharply, and that's putting a lot of pressure on the CPI. But when you take out gasoline as a factor, inflation seemed a little bit cooler, running at about 2%. So the Bank of Canada is not simply looking at a demand driven inflation problem. It's looking at an energy price shock, mainly driven by the conflict in the Strait of Hormuz and between US and Iran, but it's also looking at other major global trade issues. It's also factoring in currency volatility and still fragile consumer conditions. And that brings us to the other side of the issue, which is that Canada's economy has basically stalled. Real GDP was negative in the first quarter of 2026, and annualized, this is a negative trend. And that followed a contraction in the fourth quarter of 2025. So while Canada may be flirting with a technical recession, many pundits are debating whether people should really be concerned or not. Business and foreign investment is weak. Canada's tax regime is fairly punitive for investors, and there's a lot of trade uncertainty going on with the United States, which is giving both businesses and foreign capital a pause about investing in Canada. And while capital is sitting on the sidelines, the housing market continues to struggle, specifically the residential market, which is falling both in terms of volume and price. Wages aren't going as far at the grocery store, so it doesn't matter what the economists are saying, whether we are or are not in a technical recession at the moment, Canadians are feeling the pinch. Now, on the positive side, Canada grew by 88,000 jobs in May, and then the employment rate fell to 6.6%. And at first glance, this seems like a very positive sign. However, there's a caveat. While some of this may be evidence of some resiliency in the labor market, there's a lot of discussion around the temporary jobs surrounding FIFA and what impact this is having on the job numbers. There's a lot of hiring for event coordination, customer service, logistics, transportation, airport, and food services and security personnel. But the Bank of Canada has to ask itself whether this is real, durable, permanent growth, or is it a temporary surge for a once in a generation event here in Canada? Certainly, no central bank or economist should be overreacting to a sensational employment event. So, inflation is too high to justify cutting rates, and growth is too slow to justify hiking them. And that's why the decision from the Bank of Canada this morning was to hold the overnight rate at 2.25%. But there's one more factor that Canadians need to understand, and that's the United States. Their inflation numbers released this morning at 4.2%. That is materially higher than Canada's inflation number, and the US Federal Reserve is now under new leadership, with new chair Kevin Warsh having his first policy meeting next week. The US Federal Reserve has a current rate range of 3.5 to 3.75, while the Bank of Canada is holding at 2.25%. That is a meaningful interest rate gap. If US rates stay higher for longer than Canadian rates, then capital is naturally going to gravitate to where it's going to seek and get a better return. And that could put increased pressure on the Canadian dollar, which is not a priority factor in the Bank of Canada's decision, but it is part of the overall decision making process. A weaker Canadian dollar can make imports more expensive, which means anything the US market is exporting into Canada is going to become materially higher, more expensive for Canadians, not only in their consumption, but in the goods that are required to produce things here in Canada. So if the Bank of Canada decides to cut rates too quickly, the Canadian dollar may weaken and import inflation will rise. If it decides to hike rates too early, then the weak economy can face increased headwinds. And by holding, Canadians don't get any relief on their mortgages, but the Bank of Canada buys itself some time. Essentially, it's a pause in a very uncertain economic environment. So again, this boils down to the problem that Ludwig von Mises identified decades ago, and that is that most people misunderstand inflation. And instead of looking at what causes inflation, they look at the symptoms of inflation, which is rising prices. But for the Bank of Canada to wait for the other shoe to drop with economic data around the world is not the same as winning. If you found this video to be helpful in your journey of discovery on politics, history, economics, financial literacy, and philosophy, make sure you give us a like, subscribe, and hit that notification bell for upcoming videos.